Welcome to The Explainer. Today, we're doing something I find absolutely fascinating. We are looking under the hood of the mortgage finance industry to see the data and the standards that actually keep it running. If you love structured information and getting right to the core of how complex financial systems operate, we're going to have a great time today. Let's jump right in. Okay, let's dive into this. Have you ever wondered who actually holds the keys to home ownership? We tend to immediately think of real estate agents or the buyers themselves. But, the real engine behind the dream of owning a home is the mortgage finance industry. Without the highly structured flow of capital from these financial entities, the everyday reality of buying a home would literally be out of reach for the vast majority of us. It's the lifeblood of real estate. It's a really powerful thought, honestly. Before we even touch on complex financial metrics, we have to recognize that this industry isn't just about moving money around. It provides a profound societal value. The mortgage finance industry provides an essential public good by enabling consumers to purchase homes and contributing to the overall home ownership rate. So here is our quick roadmap for today. We'll be hitting the mortgage finance industry, SICS code FNMF, ethical lending practices, combating discriminatory lending, environmental risks, and finally, why accountability matters. All right, sections 1 and 2, the foundation, defining SICS code FMF. So what exactly is SICS code FNMF? Well, it stands for the Sustainable Industry Classification System Code for Mortgage Finance, and it sits right within the broader financial sector. Very simply, this classification applies to entities whose core activity is lending capital to both individual and commercial customers using property as collateral. So we're primarily talking about the issuing of residential and commercial mortgages. This is the fundamental bedrock mechanism allowing individuals to finance a house and businesses to finance commercial properties. Now, to understand how this industry is measured for risk and sustainability, we're using the SASB standards as our analytical lens today. Think of the SASB framework, which is now under the International Sustainability Standards Board, like a highly detailed nutrition label for the financial world. It reveals the inner workings, the specific metrics, and the hidden risks of mortgage portfolios to investors and regulators. It demands total transparency. Now, what's really interesting is that the industry's scope actually expands significantly beyond just lending out capital. While originating those residential and commercial mortgages is the primary product, for sure, these entities also engage in vital secondary services. We're talking about mortgage servicing, title insurance, closing and settlement services, and property valuation. Some entities even manage and finance real estate-related investments, like collateralized mortgage obligations. It's a vast, incredibly interconnected ecosystem. Moving right along, Section 3, Pillar 1, Ethical Lending Practices. Let's contrast some loan types for a second. Combine fixed and variable rate mortgages versus prepayment penalty mortgages. Why does the SASB standard care so much about this distinction? Well, it all comes down to remuneration structures. You see, the way mortgage originators get compensated, their bonuses, commissions, profit sharing, the whole shebang, might unintentionally incentivize them to promote complex lending products that are completely unsuitable or just too risky for the client. If an originator pushes a loan with a prepayment penalty just to hit a monthly quota, it creates a high concentration of risky products in the portfolio. And that invites heavy regulatory scrutiny and really costly litigation down the line. But, sometimes things don't go as planned. When those risky loans fail, the industry has to track the distress. Standard setters actually require entities to report the exact number and loan value of 3 specific things. First up, mortgage modifications. This is when the original terms, like the interest rate or term length, are changed. Second, foreclosures, where the borrower defaults and the property sale is forced. And third, short sales or deeds in lieu, where the lender basically accepts less than the full debt owed just to avoid foreclosure. Transparency in these exact numbers is absolutely critical for long-term investors to accurately gauge the health of a portfolio. All right, Section 4, Pillar 2, Combating Discriminatory Lending. And this brilliantly illustrates exactly how standard setters look at the data. To prove they're operating fairly, companies are required to disclose lending data across 3 specific metrics: the number of loans, the total value of those loans, and the weighted average loan-to-value ratio. Now, this data is separated out by minority borrowers versus all other borrowers. And it's really important to note here, the standard relies on a very specific definition of minority established by the UN. This ensures a strictly standardized, data-driven approach to tracking whether pricing and loan issuance are genuinely equitable across all demographic groups. But look, just reporting the raw numbers, That doesn't cut it. Entities must actually describe their internal controls, which means proving they have actionable policies in place right now. We're talking adequate training of their loan originators, underwriters, and staff, rigorous lockdown documentation and record keeping, proactive monitoring of their loan portfolios for any race, gender, or ethnicity disparities, and crystal clear disclosures to borrowers. Implementing these strong processes mitigates massive risks, including huge regulatory fines, terrible reputational damage, and mispricing of loans. Okay, Section 5, Pillar 3, Environmental Property Risks. Here's the thing. Because mortgages are backed by actual physical properties out in the real world, an increase in extreme weather events poses a massive financial risk. Standard setters require entities to incorporate specific weather-related natural catastrophes directly into their underwriting processes. This includes meteorological events, so things like hurricanes and severe storms, hydrological events like floods, and climatological events like heat waves, droughts, and wildfires. Interestingly enough, the standard actually excludes geophysical events like earthquakes from this particular metric. It focuses strictly on climate-related impacts that could result in missed payments, loan defaults, or sudden drop in asset values. 1%, I know, it's almost tiny, right? But this single digit is actually absolutely crucial. It defines the 100-year flood zone. A 100-year flood zone is basically any land area that has a 1% or greater chance of flooding in any given year. Standard setters explicitly require entities to disclose the number and value of mortgage loans in their portfolio that are located right in these zones. It's an undeniable, vital metric for assessing just how exposed a portfolio is to severe water damage and sudden loss of collateral value. To really quantify these environmental risks, entities use two main formulas. First up is total expected loss, which is basically multiplying possible financial losses by the probability that they'll actually happen. The second is loss given default, or LGD. Think of LGD as the actual slice of the asset's value that just vanishes if the borrower defaults. By tracking expected loss and LGD specifically attributable to extreme weather, investors get a super clear picture of the potential financial hit a portfolio might take when nature strikes. And finally, Section 6, Conclusion, Why Accountability Matters. So, the crucial point here is that the mortgage finance industry definitely does not operate in a vacuum. Recent trends, especially the massive regulatory shifts we saw following the 2008 global financial crisis, demand a serious, structural alignment between the interests of society and those of long-term investors. The whole shift is heavily leaning toward tighter consumer protection, totally transparent disclosure, and strict accountability. When an entity adheres to these standards, they aren't just checking a compliance box, they're actively upholding that essential public good we talked about at the very beginning of the explainer. As we wrap up, I want to leave you with this question to chew on. How does transparency across these three pillars, ethical practices, non-discrimination, and environmental risk, protect both your community's future and our long-term economic stability? Because at the end of the day, when the entities under SICS code FNMF are truly accountable, the foundation of homeownership remains solid for everyone. Thank you so much for joining me for this explainer. Keep learning, keep asking those great questions, and I'll see you next time.